Sheet 101 for restaurants with Paperchase. Every month, your accountant will send you financial reports that tell you a lot about your restaurant's health. These reports will contain three main items. The first is the P&L, then there's the cash flow statement, and finally, the balance sheet, which is what we'll be going over today. The balance sheet is a snapshot of a company's financial health at a specific point in time. So if your P&L is kind of like a video capturing a business's progress month over month, then the balance sheet is like a picture. It tells you exactly where your business stands at a given moment. A balance sheet consists of what the company owns, its assets, what it owes, its liabilities, and what is left over for ownership, its equity. Assets are resources that a company owns and can use to generate income. There are two categories of assets: current assets, which are liquid assets, and non-current assets, which can't very quickly be flipped to cold hard cash. Current assets include cash and your inventory, so the things that you have that you can sell to make into cash. Non-current assets include things like your POS, your building, your vehicle. These are items that might take a little bit longer to actually sell and flip into some liquid assets for your business. Liabilities are the company's financial obligations or debts. Liabilities are divided into current liabilities, which are liabilities that are paid off in 12 months, like your AP, your accounts payable, what you need to pay your vendors, as well as non-current liabilities, liabilities that are paid off after a year. So for example, like a 5-year loan. If you take assets and subtract the liabilities, you'll get the equity, which is essentially the ownership stake. This is the value of the company that belongs to the owners. There's common stock and retained earnings included in this category. So you can understand your balance sheet in short by doing assets minus liabilities to equal out your equity, also known as your net worth or your capital. So let's take an example. Let's do a bakery, for example. In their assets, they have combined $100,000 in inventory and cash on hand. They also have in liabilities around $60,000 in bank loans. That means if you take $100,000 in assets and subtract the $60,000 in liabilities, you're left over with $40,000 in capital. That's the owner's share of the business. Now let's look at this in a typical balance sheet format. So in this example, we have our bakery with current assets including a business account that has $50,000, accounts receivable, which is money that we're waiting on from Grubhub, which is $1,000. Then we have our food inventory totaling $39,000. Those are our current assets. Under our non-current assets, which again are items that you can't quickly flip, we've got kitchen equipment totaling $10,000 in value. Then under our liabilities, under current liabilities, we have an accounts payable owed of $10,000 to our vendors. We also have $1,000 in credit card debt. Under non-current liabilities that will take a little bit longer to pay off, we have a 5-year loan totaling $49,000. What's left over when we take our assets and subtract the liabilities is $40,000 in equity. We're splitting that between two owners, $20,000 each for myself and the other owner of the business. This is a typical balance sheet example, but we'll go more in depth in a webinar that we're hosting. You can either join us or watch the recording in our next video. Thanks so much.